In 2020, the Federal Reserve rolled out the printing machine and created more money that had ever been created before, and fueled an inflation that is driving prices up and is breaking us all down. More than that, now major banks are crashing. Are we going to have a recession? The question right now might be more, are we going to have a depression, and how bad is it going to be? But first, hang on. This is not financial nor professional advice. This video is for entertainment only. Hey everyone, welcome to my channel. I'm Stephen Fox, and today I'll be your guide to what is likely to become the coming American and worldwide depression. We have so many problems right now. We've been hit with one thing after another. The war in Ukraine is making things much worse. We've had supply problems, we've had health problems, and now we got some relief from the Fed printing the money off like they're able to do, because we're the reserve currency, we can do that. And it was a blessing at the time, and now it's turning into a curse. In the last 2 weeks, we've managed to have the second largest bank failure in U.S. history with Silicon Valley Bank. And it was a funding source for innovation, for startups, and for entrepreneurs and venture capitalists. It was in the heart of technology, Silicon Valley, and it was large. I mean, it's the second biggest bank failure in United States history. But that wasn't enough. We also have had the third largest bank crash in U.S. history. The largest was Washington Mutual back some years ago, and I have memories of that. God, I'm getting old. I remember Bear Stearns going broke, Lehman Brothers going broke, and that was the indication that the Great Recession was coming. I don't remember periods like this except when something big was coming, and there's more coming because there's so much more we don't know. What I'm showing you is a chart of an assessment of how risky each bank's balance sheets were. The higher the number, the worse it is. The higher the number, the more risky that bank is, because it has a very risky balance sheet. At the lowest risk banks, and number one is JP Morgan, where I have my funds, okay? And then Bank of America is second, Citibank is third, and Wells Fargo is fourth. So, those are well-capitalized banks with good balance sheets. You'll notice at the top, you see a green arrow. That's where Silicon Valley Bank was. And there's 34 more banks that are rated more risky than Silicon Valley Bank, which has already failed. Those banks haven't failed yet, but they have a more risky balance sheet than Silicon Valley. Wow. We are in real trouble, folks. And even with all that bad news, we keep getting reassurances from Janet Yellen that, hey, there's nothing to see here. Everything's okay. Just move on. The third largest bank failure in United States history was Signature Bank. And part of their problem, it was all the problems I've mentioned before about depositors withdrawing their money. and then banks have to cash in their bonds, which have decreased in value because the interest rates have been raised. It's a strange situation with bonds. It's sort of reverse thinking, but as interest rates goes up, the bonds that they've held long term go down in value, and if depositors are taking their money out, the banks have to then cash in those worthless bonds. They're not worthless, but they are worth less than they used to be, and they take a big hit. I mean, as a depositor to a bank, you are lending the bank money. You have never thought of yourself as a lender before, but believe me, you are a lender to the bank, and the bank owes you a debt. So why are they charging us fees for us lending them money? That's a good question to ask. The third largest bank crash in U.S. history, Signature, was partially due to their involvement with crypto. And there was another bank, Silvergate, which was a crypto lender. And they went broke mainly because of crypto. And crypto came down so severely in price from 66,000 to 20,000. Credit Suisse in Switzerland is a little bit different. Well, it's a lot different case. That bank has been mismanaged for years and has been slowly going down, but it's sort of a bank of more consequence. It's 5 times the size of Silicon Valley Bank. It has like 800 trillion, not trillion, 800 billion of total assets. 800 billion. Wow. So it has ongoing management problems which have been exacerbated by the problems that are affecting all the other banks. So they finally got bailed out by the Swiss National Bank, which said, we're going to back you up. If you have liquidity problems, we're going to give you the money. So they basically got bailed out. And I think what's happening is there's a general feeling, and this is my strong feeling, that they should insure all the funds that you put in the bank. You take enough risk keeping a job, investing in real estate, investing in gold. I don't care what you invest in. Invest in the stock market. Invest in Bitcoin. Yeah, you're taking a lot of risk. Okay. Why should you have to worry about the money changers? Okay, you've already taken the big risk. You're living your life. You're putting your heart and soul into it. Why do you have to worry about if the money changer who's taken fees from you for handling your money is going to go broke because they're off doing things with your money that you have no knowledge of? That's ridiculous. The stock market has been rallying on the bailouts, and it's bailouts of the depositors in the case of the 3 banks the United States has decided to insure all the money of depositors, whether they're above the $250,000 FDIC limit or not. Okay, and they did that to prevent runs on banks. And the Swiss National Bank, more or less, that was a bailout of Credit Suisse. And so you've got these complex situations where the stock market is seeing the bailouts as, they've given the signal that, depositors are going to be okay. There's not going to be bank runs. And so we took that as very positive. We took the Credit Suisse bailout by Swiss National as very positive. And then there's another bank that's very important in this whole scenario. First Republic is coming closer to being more like a bailout. And its symbol is FRC. The Fed had given them $109 billion of liquidity because they were having a run on their bank, okay? But that wasn't enough. And what was happening is people were leaving Free Republic and going to the big banks, to the JP Morgans, Bank of America, Citigroup, those types of banks, and they were deposited with them. Understandably, they're looking for safety with the larger banks, and so in some sense, like JP Morgan benefited from First Republic having difficulty and losing depositors. And so Janet Yellen more or less got these banks to give money back to First Republic, but they didn't give it to First Republic. They just deposited it into First Republic. And in that way, they're providing liquidity because that's where banks get their money to operate. You deposit money in a bank, you are lending your money to the bank, okay? And that's more or less, I think Janet Yellen made the case that, look, you have benefited from First Republic having problems, and you can give some of that back to them, and you will get the money back because it's only going to be for 120 days, okay? But First Republic stock has been going down, is still going down even after they've done the 109 billion, then they did 30 billion. Wow. So this week I watched another nice little fake rally, and I waited till Friday, and then I shorted with Sorty, SRTY, which has a lot of regional banks in it. It's a triple leverage inverse fund on the Russell 2000, which has a lot of regional banks in it. So, and it worked out. It was no big deal. And I'm just not investing in this market for now, except to short it now and then when it seems obvious. And you will get these flurries. I'm sure when Powell speaks, or when he testifies, or when he decides to lift the interest rate on the 22nd, it's likely that he will do a quarter of a point, but he could do nothing. But I think it's more likely that he'll do a quarter of a point, but then talk dovish, okay? And the press and everyone will take that as positive, and you'll get another nice little rally. But I expect the economy to tank more and more until this inflation gets under hold. And they really got to kind of tone it down with the interest rate increases because they're breaking down too many banks. I think the economy is going to go into a recession for sure. It could go into a depression. We do have some good signs, like Federal Express is saying that they're doing well and they expect increased profits in the future. So we have these things in the economy that are hot, that keep us above water. But I don't know if that's going to continue. To some extent, to get inflation under control, you need to go through a mild recession. And I think with the stickiness of this inflation, that they're going to have to hold interest rates too high for too long, which is going to cause a severe recession anyway. It'll be at least a moderate. I used to think it would be a mild recession. I now think it's at least a moderate to severe, and it could really drop off the edge if things go poorly on a geopolitical basis, especially. Thanks for listening and watching. Be sure to smash the like button, subscribe if you haven't already done that. Hit the little notification bell if you want to be notified of future videos, and thank you.